Hi, I'm Peter Rose, founder of Longwood Currency Trading. After you take a big loss, make the next trade. Don't be in fear. You just got to make that next trade. I'm out here. It's a beautiful summer day. I've done quite a few videos out on the porch. Probably will do that as long as the weather holds up, because I live in New Hampshire in the Lakes region of the United States, if you're not familiar with where I'm at. And the winters, you don't sit on the porch at all. And I have my coffee. I just got done walking the bow dog, and he had a lovely time thrashing around in the woods. And it was sort of a follow-up to my last video where I talked about the likelihood of having a statistical series of losses and all that other sort of stuff. So that was from kind of the technical side of things. From the practical side, from a trader's viewpoint, a loss is just that. It's part of the game. But a big loss can really throw you off kilter unless you understand what your process is, what the methodology is. You know, I have part of my course is titled Process-Oriented Trading. First I have the what. I answered 3 questions in my course. What, how, and when. You know, what do you need to know? What tools do you need to know in order to plant a garden? How do you use those tools? And more importantly, when do you plant that garden? Because if you plant it at the wrong time, you try to plant the garden in the winter, it's not going to go too good for you. So in trading, it's the same thing. You answer those same 3 questions: what, how, and when. And you do that in the first presentation, which is called Foundations. You build the foundations of what all this stuff is. Now, depending on what level of trader you are, I have an advanced version of that that's 3 pages. And I have a more beginner type version of that, which is about 130 pages. Because you can keep peeling the onion back on just the what aspect. The how is covered in the next section of the course, which is principles of FOREX trading. And the when is covered in process-oriented trading. Because a methodology of trading, which is what I propose that you use instead of a system. A system is an engulfing candle pattern that you're following, or somebody's London Open, or Bollinger Bands, or whatever. Those are all systems, and they're dependent upon either what somebody else is doing or what some lagging indicator is indicating for you to do, which I don't have any use for any of that stuff. So, but a methodology is a process that you follow in implementing rules that you've created, with each rule having certain conditions. Now, it gets pretty technical in there. It's all really simple when you put it together, but you're not going to learn it from a book, and you're certainly not going to learn it from most of the folks that are out there, because they don't have the same background that I do. I was a software engineer for 33 years. I got a degree in physics, almost a minor in math. I had a 40-year career as a real estate investor. So I'm able to look at the big picture of things and break them down into logical, sequential pieces that are then easier to solve. And one of those problems that we come into is a big loss. You could say, oh, I'm very rigorous with my stops and, you know, all that sort of thing. But at issue is, what do the big traders do? The institutional traders. Institutional traders don't have stops. And there's a reason for that. When you're starting out in your trading journey, you're using stops. And I propose very short stops. By getting stopped out, you learn what not to do. And as Jesse Livermore said, when I know what not to do, I then know and understand what to do. And the best education that you can get in the market is to invest your cash, track your results, and learn from your mistakes. When you don't make any mistakes, you don't learn. That's the implication of that. And so as a beginner trader, or not even a beginner trader, I don't teach beginners, but for the intermediate folks that I counsel and work with, the important characteristic in rebooting yourself as a trader is to start over again in a very rigorous environment of risk management. Once you get to a certain point in your trading, it's based on both experience and the number of lots that you trade. But once you get to that point, then you start loosening up on the stops, and you rely more and more and more on process and methodology than before, when you were learning, where you were following a map, a guide. Too often, what is being presented out there in education land is very strict guides, very strict rules. Don't risk more than a half a percent of your account, and don't do this and don't do that, and do this and do that, and the Bollinger Band does this, and the RSI confluence, and then you go and you do this. That's irrelevant. It's presented by people who really don't understand how to trade, or they do understand how to trade, but they don't know how to teach it. They don't know how to present what they know. Because look, not everybody that's good at something understands how to teach it, understands how to share it. I mean, you could be an outstanding swimmer, but could you be a coach? The greatest golfers in the world have caddies. And when the caddy says, you know, you might try this thing here, and the golfer listens to them, because the caddy is taking an objective view of them. The swimming coach is taking an objective view. Has the swimming coach won a gold medal? Probably not. But the gold medal winner listens to the coach because they can take that objective view of what you're doing. And the coach, in their day, or even then, is still a really good swimmer. So what do you want to do? You want to make $1 million or $2 million trading? Or do you want to replace your job income, $60,000, $100,000 a year, $30,000 a year? Wouldn't that be really nice if you didn't have to work for a living? You could replace your job income. Are you a mega millionaire Forex trader? No, you're not. Are you going to be a mega millionaire Forex trader? Probably not. If you look at the guys that are out there that are teaching that are worth millions of dollars, their students aren't worth millions of dollars. Why? If they have all the secrets and they know how to do this, how come the students don't? The students get good, maybe, depending on the ability of that person to educate, to share their knowledge. But are they really able to convey what they do intuitively based on knowing what not to do and the 10,000 things that they stumbled into and not in learning? After you take a big loss, you have to determine, is that well, they're all learning opportunities, but did you do something stupid? Or were you just caught in circumstance? You know, when you're trading 15 lot positions at $10,000 a lot, if you're trading 10 to 1 like I do, your attitude changes from when you're trading 2 lots or 3 minis or something, because there's some significant money on the line. If you're trading 15 full lots and you have a 10 pip stop, that's $1,500. So that's different than if you're trading a mini and you lose 15 pips. That's 15 bucks. $15 versus $1,500. If you don't think things will change just because the decimal point changes, you are radically wrong. When that decimal point changes, and every time that decimal point changes, things are very different. And the methodology that you have has to be malleable enough to go into those new situations, just as I discussed in my last video about people who, for example, learn how to trade when there's a long upswing in the market, where you have this big trending market. Regardless of that, the discussion in the last video, if you'll remember, was you learn during a trend, and then you think you're a hero and you're winning all these trades and all this money, and all of a sudden the market goes into a sideways range and you start to get chopped up, and you don't understand how to change that, because the Bollinger Band is going to help that. You're trading the Golden Cross, you're going to get killed. All these systems break down. If everybody's making a gazillion dollars trading robots, then everybody would be trading robots. But very rapidly you learn that if you don't know how to counter a program and stuff, and what to look for and what the characteristics are, remember, the robots know better than the person who trained it, who wrote the code to make the decisions. And the only decisions that the robot can make is based on trending systems. They are unable to respond quick enough in real time to a market that goes into a chop or into a range. A methodology adjusts itself based on the price action signals that are being sent. It's like driving a car. You know, you're driving along and you've got this open highway in front of you, and everything is going along fine until you see the rabbit come out of the woods, and then you need to slow down. And then you don't just slow down for that one rabbit or deer or whatever. You slow down because there may be others to follow. You know, I live up here on a small mountain in the woods in New Hampshire, and we have turkeys up here, and they're the dumbest shits in the world. And you get one of them, you see one of them on the side of the road, and they're walking across the road like that, and you think, well, I got this time, the turkey will go by, and I'll just keep going. Well, they don't recognize you. They just stand there and look at you, and the rest of the turkeys behind them, because there's always a gaggle of them, or I don't know what you call it. I know a goose, there's a gaggle of gooses, but I don't know what you call a bunch of turkeys, but they're going to come right out. So you don't just slow down for that one turkey. You have to know that there's going to be a bunch of them, and you stop. You wait for the turkeys to go by. Because if you get, my wife and I were driving down the road one time, and this dumbass turkey comes flying out of the woods and banged into the side of the car and knocked her rear view mirror off, tore the thing right off the car. These fuckers are like 30 pounds, and they're moving fast, and you're moving at 40 miles an hour. Well, that's a lot of force. And in the currency market, you don't just get this gradual transition to a range-bound movement. All of a sudden, that thing will swing around and boom! And if you're not paying attention, and your average position value has been trailing up because you've been staging into that position incorrectly, you're going to get wiped out. You're going to take that big loss. So if you take that big loss, it's either because you're inexperienced and you don't know what you're doing, or you're maybe weren't paying attention at that time, or you thought, oh, well, this is just going to be this minor retracement. Well, we don't know what those minor retracements are going to be. You know, we can say on the major currency pairs, then a retracement, you know, might be 30 pips. Averaging 15. And so if you're following the trend and you want to stop, set it 15 below. If it goes below that, then you're going to take your heat. But if you're staging into the position and your average position value goes up, you start losing maybe just a little bit of money. But you start losing that all the time, and you think, oh, I need a longer stop, or I'm just going to take the stop off and let that fucker run because it'll come back. It's just a retracement, and that's where you get caught. That's where you'll have your big loss. So if your win-to-loss ratio isn't very good, you're not going to make it up. You're going to be behind maybe a couple of weeks of trade. You're going to lose a couple of weeks of trading because you lost $300 or $400 or $500 when you should have lost 80. That's a big loss in relationship to trading a one-lot position. $400 is a lot. It's 0.4%, right? And you say, well, that's only 0.4% against your risk. Well, yeah, but 0.4%, you do that every day for a week, is 2% that, on your bank that you've lost. that's significant as you go through. Those big losses can really affect not only your bottom line, but also really screw up your metrics. And if you don't really, if your metrics are all over the place, in other words, if your trading isn't consistent losses, consistent gains, you can't develop a good set of metrics. If you're taking these huge losses because you're stupid and don't know how to trade, and you're building your metrics based on having these losses mixed in there, you have to mix them in. You can't just cherry pick and say, well, I'm going to throw out the 3 worst trades and I'm going to throw out the 3 best trades and average out this ridiculous series of trading metrics that you have, and you depend on your ability to step on the gas and add to that trade and all that stuff based on these metrics, you're going to get crushed. If you don't have the correct education on how to manage this as a business, you're going to get sunk. You just can't go in there because some jackass is driving around in a Lambo and telling you that he's going to take a $500 account and run it to $30,000. Maybe he can do that because he's playing with 200 or 500 to 1 leverage, and he knows well enough to cut that trade really quick, and then he knows that when the price is really going to run because of his experience, he jumps on the bandwagon, he loads up at 200 or 500 to 1, away that $500 goes. 5 times a winner right there. Get a 5 or a 5 or a 10, 20 banger on that $500, which then becomes 3,000, which then becomes 9,000, which then becomes 20,000. But you have to understand through losing where you can push it and where you have to jump out. If you don't understand that and you don't have that skill, you're going to take a big loss. And if you take those big losses, it's just going to crush you. But what's going to happen is that you're going to try to make that money back. I don't care who you are, you're going to try to make that money back. And how would you do that? You got to get more pips, you got to add more leverage, you got to run with longer term trades so that it makes these 100 pip moves that you need to make that up, as opposed to what you're good at, making 10 pip days, 20 pip days. You know, if you were a 60-40 trader and you put your stop at the same level that your average winning value was, you'd come out fine. You'd make money with the stop and the profit the same. You lose $100 4 times and you make $100 6 times. You see what I'm saying? If you don't lose the big loss in one trade, you'll certainly have a string of trades that just add up to a huge amount of money by you screwing around trying to make up the $500 or $1,000 that you lost that you thought was big then, and now you're trying to make it up and you end up losing $5,000 altogether. You've lost half your bank trading one full lot. You got to be really, really careful about what you're doing after the big loss. If you don't know what you're doing, or your education is weak and you don't understand what I'm talking about in these videos, then after that big loss, you need to shut the door and sit on the toilet for a while and not trade. You need to get away from that loss so that you can change your attitude, and you need to just start over again with the bank size that you have left over. You can't try to make that back. But if you know what you're doing and you can differentiate a bad luck from a statistical standpoint from, oh, I see what happened, I just pushed it a little too hard, great. After that big loss, then your job is to make that next FOREX trade, because that next trade should be based on the same principles that you did the other one on, except it's just a statistical anomaly. And you'll be able to make that back. The problem is, again, regardless, it's still a big loss. And by trading at the same consistent rate that you have, if you don't find yourself in a position where you've got a runner and you can start adding lots onto that, and then you might be able to make those losses back really quickly. It's going to take you time to just get back to even to where you were. And that's time that you could have been making money. I had a huge loss, I was 3 years ago or something. It just went crazy. I mean, I think it was a carry trade, and I didn't put any stop on it. I woke up in the morning, I had totally read the thing wrong, and I lost like $22,000. I went, holy crap, that's just awful. But there was such a volatility in the market, I just followed my rules and took advantage of that volatility the next day, and I made $26,000 back. So you can make that back, but your methodology has to be such that you're following the methodology, and you're not saying, "Oh my God, I'm going to add a whole bunch of extra lots here. I'm going to increase my leverage from 50 to 1 to 500 to 1," or just doing stupid shit, because it'll just get worse. It really will. Be very careful. This is a very important video. I hope everybody stayed this long. Chances are they haven't. If you're still listening to this, thumbs up to you. You're going to be all right. You're going to be successful. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.